Welcome to the Deep Dive, your shortcut to getting up to speed on the market's key conversations. Today we're digging into the Howmet Aerospace Q3 2025 earnings call. That happened midday, October 30th. And this report, well, it wasn't just a beat, was it? It felt more like a showcase of really strong execution.
That's absolutely the right way to look at it. I think the core takeaway here is how that disciplined operation is, really translating into bigger margins. And they're doing that while aggressively putting capital to work for future growth, secular growth. We really need to unpack why these results looked so good, especially the quality of that profitability, because I think that explains the rally we saw in the stock, even with some, initial choppiness right after the numbers came out.
Okay, let's kick off with a high-level summary then, because the strength was pretty broad-based. Revenue hit $2.09 billion. That easily beat consensus, and it's up 14% year over year. Adjusted EPS kept pace, coming in at $0.95. That was a solid 4-cent beat against the street.
Yeah, but the real story, for me anyway, is that margin quality. Adjusted EBITDA broke $600 million, which pushed their margin all the way up to 29.4%. Now, that's a big expansion, 290 basis points year over year. What's really critical is hitting that near 30% margin, even while absorbing pretty significant near-term labor costs. They added, 265 net heads just in the engines business in Q3. That's a conscious investment, right? They're preparing for the future ramp up, and yet the profitability held up incredibly well.
Wait a second, though. Adding that many people usually takes a bite out of margins right away. Is that a risk for next year's labor costs? Or does management sound confident they can monetize that investment quickly?
Oh, they sound explicitly confident about monetization. The staffing is strategic. It's all about positioning for that 2026 build ramp we'll get into later. But what this margin really shows is just tremendous operating leverage. We heard on the call that the Q3 incremental margin was something like 50%, a phenomenal 50%. That's way above their historical targets. And that kind of efficiency, well, it just validates the whole production thesis, doesn't it?
Okay, that level of leverage brings us straight to the balance sheet and, importantly, the cash generation. Free cash flow FCF looked exceptionally strong, $423 million in Q3 alone. And this isn't just, spare cash. This is the engine for future growth and those shareholder returns.
It absolutely is the foundation. Look, they are investing heavily. They put $108 million into CapEx just in the quarter, and about 70% of the total CapEx so far this year. That's focused squarely on the engines business. So that's a clear signal. They're funding growth from internal resources, and yet they still kept that strong FCF conversion, which lets them stay aggressive on returning capital to shareholders.
And their actions really underline that management confidence, don't they? They deployed $200 million for buybacks in Q3, and they've been pretty consistent with that, over $600 million year to date, while at the same time hiking the quarterly dividend by 20%.
Exactly. And this is growth funded by high-quality earnings. It's not funded by leverage. Their net debt leverage actually hit a record low, just 1.1 times net debt to EBITDA. The credit markets clearly noticed this strength too. S&P upgraded their rating to BBB plus silver. Moving 3 notches into investment grade like that, well, it signals that this growth story is built on really solid financial discipline.
All right, let's pivot now to the market drivers, starting with the main engine, aerospace. Commercial aerospace revenue overall grew 15%. And here's the key insight, I think, that aftermarket spare story. It's accelerating like crazy.
Oh, absolutely. The number that really jumps out is that total spare sales increased 31%. And specifically within that, commercial aero parts sales surged 38%. That just totally validates this multi-year tailwind narrative. Aging fleets, planes flying a lot, long waits for new jets. And that's high margin revenue, right? Flows straight to the bottom line. Defense aerospace also looked robust, up 24%. That seems driven by steady F-35 builds and, again, strong engine spares growth there too.
But the surprise element, the thing that adds some nice diversification to the picture, that came from the industrial side. We definitely need to talk about the strength they're seeing in industrial gas turbine, or IGT, demand.
Yeah, this could be a narrative changer. Combined IGT and oil and gas revenue grew 18%. But IGT specifically was up 23%. And the catalyst here is this massive structural build-out of data centers. It's huge. These places increasingly need mid-sized turbines that think up to 45 megawatts for their own independent power or, fast backup from the grid.
So wait, an aerospace part specialist is basically becoming an infrastructure supplier for the whole data economy.
Pretty much. It kind of blurs the lines between the traditional IGT market and oil and gas, and it provides this critical new secular growth driver that's frankly less tied to the ups and downs of the commercial aero cycle. Management sounded like they expect this data center demand to be strong for multiple years. And if you connect that to the bigger picture, it significantly de-risks their exposure compared to maybe past industrial cycles.
Now, contrasting that strength, they did call out one clear weak spot: commercial transportation.
Yes.
Specifically, the wheels division.
Yes, they did. Volume in that wheels segment was down 16%. Management pointed directly to, well, low freight rates combined with those persistently high truck prices, which they noted are also being made worse by tariffs. So it's still a challenging market there in the near term, though management did confirm the overall tariff drag on the whole company is still pretty small. Negligible, really, and mostly managed through pass-throughs.
Okay, shifting to the outlook then. Management gave a pretty substantial boost to the full year 2025 guidance that really reinforces the bullish story we've been talking about. Revenue is now guided at $8.15 billion, adjusted EBITDA at $2.375 billion, and FCF, they're expecting that to land around $1.3 billion, which that FCF number is significantly higher than they guided before.
Right. And they even gave us an early peek of fiscal 26. They're projecting roughly $9 billion in revenue, which implies, about 10% year-over-year growth. And to actually hit that growth, they're investing pretty aggressively in capacity.
Yeah, that investment seems key to holding on to that margin advantage. Tell us a bit about the strategic build-out they're doing.
Well, they've got 5 plant expansions going on right now. That includes the huge new Michigan aero-engine core and casting plant. Apparently, that facility is already starting to make some initial parts, so it's positioning them for that big 2026 narrow-body ramp-up. Management basically said they expect CapEx to stay high right through 2027, really, to capture all these opportunities in both aero and IGT.
Which brings us to their technology edge, right? That's what determines if all this high CapEx actually delivers lasting incremental margins. We should probably talk about the complex manufacturing involved, especially in those hot section components.
Yeah, what's fascinating there is just how sophisticated these parts are becoming, particularly this push towards increasingly cored turbine blades. You have to imagine building this really complex internal network of tiny air passages right inside the metal of the blade itself. This kind of precision lets the engine run much hotter, and that boosts fuel efficiency, obviously, but it also significantly increases the value, the content value of their part.
And this tech leadership, it's partly driven by their internal efficiency tools, isn't it?
Exactly. That's where this idea of the digital thread comes in. It's basically their use of AI and machine learning to map out the whole production process. It lets them optimize casting yields, monitor tolerances super closely, ensure quality control in real time. That's a big reason, I think, why we saw that incredible 50% incremental margin this quarter. Sure, it's driven by volume, but it's kind of supercharged by the automation and that digital optimization layer. And importantly, we're seeing the IGT sector now demanding parts that are just as sophisticated as the most advanced commercial aero components. It's following the same tech path.
Right. And before we move on, we should probably just quickly note the executive transition. The CFO is retiring, though management did emphasize they're confident in the positive operational culture that's been built over the last few years continuing.
Absolutely. Yeah, worth noting. So putting it all together for investor context, the fact that the stock actually set a 52-week high on the day of the call, despite those, intraday swings, that pretty much confirms that buyers were reacting overwhelmingly positively to the strong fundamentals and that lifted outlook. The core investment thesis really holds. It's about sustained sector-leading operating leverage. And that Q3 incremental margin of 50% is kind of the proof point, isn't it?
And looking out to 2026, the segment growth expectations seem pretty constructive too. Commercial aero expected to be stronger, defense in the mid-single digits, and that diversified industrial segment, the IG-Toil General combo, projected near double-digit growth.
Yeah, it's a powerful, diversified setup they've got going.
Okay, so we've laid out the narrative from the call. Now for the part where we apply this analysis to the market. And just to be crystal clear, this is not financial advice. Think of it as a pitch to an investment committee based purely on the story we just discussed.
Okay, the pitch is basically a relative value trade. We've established there's confirmation of persistent, really strong aftermarket strength in aero. Plus, you've got this robust, multi-year secular growth driver popping up in IGT tied to that data center boom. The only major weakness they really talked about was that commercial transportation wheels division.
Right. So how do you play that? Capitalize on the high-quality growth, but hedge out the known cyclical weakness.
Well, the idea is you go long exposure to Howmet to capture both that growing IGT data center revenue stream and the really deep aero aftermarket strength, both high margin businesses. But then simultaneously, you'd short a pure play commercial trucking component supplier, one that doesn't have that deep aero and IGT diversification. This effectively tries to isolate Howmet's high growth, sophisticated components business from the specific weakness in their own wheels division and just the general uncertainty around freight that was mentioned on the call. It's trying to be a clean way to buy the future, essentially, and hedge out some of that cyclical noise.
And interesting, a neat strategy to try and isolate the alpha there. Okay, so to recap the key takeaways for you listening. This quarter really confirmed exceptional margin expansion. That seems powered by operational excellence. Also, strong FCF discipline and the successful emergence of this dual secular growth narrative, powered by both high-margin aerospares and that crucial data center infrastructure demand.
Yeah, and this raises, I think, an important question for you to think about. Given Howmet's really heavy and sustained investment in advanced manufacturing and this digital thread tech, just how quickly will that operational advantage translate into a permanent kind of structural step change in their already impressive incremental margins, looking out to 2026 and beyond?
We'll leave you with that thought to chew on. Thanks for joining us for this deep dive.